Hello. This week, energy markets were characterised by sharp swings in sentiment as hopes for a diplomatic resolution between the US and Iran were repeatedly challenged by renewed military action. Oil, gas and power prices moved lower overall compared with last week, despite a midweek rebound as tensions escalated once again. Markets remain highly sensitive to developments in the Middle East, particularly the status of shipping through the Strait of Hormuz. Let's take a look in some more detail. Oil prices started the week on a bearish footing after the US unexpectedly suspended airstrikes against Iran, raising hopes that diplomatic negotiations could reduce tensions and restore normal energy flows through the region. As a result, prices declined, with traders unwinding some of the substantial geopolitical premium that had been built into the market in recent weeks. Sentiment remained negative on Tuesday, with oil falling to a two-week low as reports suggested progress was being made towards reopening shipping lanes through the Strait of Hormuz. President Trump's comments regarding good talks with Iran further supported expectation of a potential breakthrough. However, the mood changed dramatically midweek. Oil prices rebounded strongly on Wednesday after hostilities resumed between the US and Iran, with Saudi Arabia becoming increasingly involved through military action against Iran-backed groups in Iraq. Reports of decline in US crude inventories, which have fallen to multi-year lows, added additional support to prices. On Thursday, prices continued to rise after the US military confirmed strikes against dozens of Iranian Revolutionary Guard targets. Although one LNG vessel successfully navigated the strait, overall shipping activity remains extremely limited, underlying the ongoing risk to global energy supplies. Last night, front-month Brent closed at $90.2 per barrel, which is down $6.67 compared to last Friday. Gas markets followed a similar pattern to oil, with prices initially falling sharply before recovering part of the losses as tension in the Middle East reignited. Monday saw significant declines across prompt and near-curve contracts as traders reacted to the pause in US-Iran hostilities. The removal of immediate supply fears allowed risk premiums to unwind, particularly at the front of the curve, where Winter 26 contracts led the losses. However, the decline was moderated by relatively supportive fundamentals, including low renewable generation, high temperatures, reducing French nuclear output, and gas storage levels remaining below seasonal averages. On Tuesday, hopes of a negotiated settlement continued to weigh on prices. Reports that Oman was working on a proposal to restore shipping through the strait encouraged further selling across the curve. Nevertheless, underlying fundamentals prevented a more substantial correction. European storage levels reached only around 56% full, significantly below the seasonal norm, with approximately 72%, while LNG imports remained weaker than last year and injection rates continued to lag. The market reversed course on Wednesday, following the resumption of military exchanges between the US, Iran and Saudi Arabia. Traders quickly reintroduced geopolitical risk premiums, leading to gains across the prompt and seasonal contracts, as concerns over global LNG supply security returned. By Thursday, prompt contracts softened slightly as the UK gas system was oversupplied. However, broader market fundamentals remained supportive. European storage levels remain below target levels, LNG imports continue to lag previous years, and uncertainty surrounding Middle East exports remains elevated. So last night, all gas contracts closed lower than last Friday. Winter 26 closed at 143 pence per therm, which is down 9 pence per therm. Power markets tracked developments in gas throughout the week, resulting in overall losses despite intermittent rebounds. On Monday and Tuesday, electricity prices fell sharply alongside gas and oil. Lower geopolitical risk premiums and falling commodity prices weighed on power contracts across the curve. Despite the broader bearish sentiment, some fundamental support remained present. High temperatures across Europe continue to restrict French nuclear output, while lower wind generation forecasts increase dependence on thermal generation. Wednesday brought a turnaround in sentiment as renewed strikes in the Middle East pushed gas and carbon prices higher. Power markets responded accordingly, with contracts moving higher throughout the curve. Reduced renewable generation in the prompt market provided additional support. On Thursday, generation fundamentals remained relatively comfortable. Wind provided around 4.3 gig to the grid, while CCGT contributed around 5.7 gig. Although these factors provided some stability, overall power prices remained heavily influenced by gas market movements. So last night, all power contracts closed lower than last Friday. Wind 26 closed at £121.4 per megawatt hour, which is down £8 per megawatt hour compared to last Friday. You can download the full version of this market report from our website. Thank you for watching, and we'll see you next week.